As you may know, our forecast for interest rates is that the Reserve Bank will cut the rates by another 1/4% this year and then another 1/4% in early next year. So the terminal rate would be 0.5%. Then they may consider the use of unconventional monetary policy. A number of options have been spoken about. The first one would be negative interest rates, and we think that's highly unlikely. When we saw that introduced in Europe, it caused a considerable pain for banks with them having to invest their excess liquidity at negative rates. And really the only benefit of those negative interest rates, in my opinion, was to lower the euro. I think the dislocation to the banking system associated with negative rates is too big a price to pay just to get the Aussie dollar down a bit further. Another option would be to provide cheap long-term funding for banks. That worked very well in the UK after the Brexit vote, and the Bank of England was concerned about the state of the economy and the ability of banks to borrow money. It worked extraordinarily well, but the Reserve Bank seems to be opposed to that on the basis that there's no liquidity crisis in Australia, and that is absolutely correct. Banks, in fact, have got more liquidity than they need at the moment. But it certainly also led to a downward push in private sector interest rates. And so I'm somewhat of a fan of that policy, but certainly reading from the Reserve Bank's current speaking, it suggests that they don't see that as a likely option. A third one would be purchasing of other assets. That's what you call quantitative easing, and that's what the US Federal Reserve did. When they pushed interest rates down to zero, they then embarked upon a bond buying program. The central bank governor seems to prefer that policy. He's talked about buying government bonds. And of course, for Australia, a particular additional source of support would be if the Reserve Bank purchased asset-backed securities. Those asset-backed securitisers are growing their books very rapidly, between 15 and 20%, supporting the housing market, where the banks, of course, are only growing their books at the moment by around 3%. So this would be seen to be additional support for the housing market. Finally, they may look at the idea of foreign exchange intervention. So printing money, printing Aussie dollars, but selling those Aussie dollars to buy bonds in other currencies. That has worked in some parts of Europe, has brought down their currencies, but I don't think that's a likely option either. Could Australian interest rates go to zero? I really don't think that's likely. I think the Reserve Bank Governor's current position is that unless the US pushes rates down to zero, we won't be pushing our rates down to zero. And whilst we expect the US to be cutting rates quite aggressively over the next 12 months, we're expecting 3 more rate cuts this year and another 2 next year. We don't think that the US is going into recession, and therefore we don't expect that they'll go to negative interest rates. So a very interesting outlook next year for potential policy movements. Thank you.